Okay, there's a question up. Your hand's up. Okay, you're welcome to ask, put on your mic and speak.
Hi, ma'am.
Hi.
So I don't know if this was talked about because I just joined the class now. So with the practical slots that have been posted, right?
Yes.
None of them correspond with my timetable. And during those slots, I have other classes as well. So according to my timetable, I'm supposed to have it
Yes.
on Wednesday at 9:40. And there's
Correct.
no slot amongst the ones that you posted on Moodle
Okay,
or that
what?
you sent.
So you belong to the Wednesday group. That's what you're
Yes,
saying.
yes, ma'am.
Okay, I will go look at the main timetable because we are given a third-year timetable. So what I did do is I looked at all the slots for each third-year group, and all groups were able to at least attend one of those slots. So I'm not
So,
sure if you are repeating any subjects from first or third year. I mean, sorry,
um,
second or first year. That might be the clash.
I understand what you're saying, but I'm not repeating any modules. And with my group, we had the same problem with accounting. So, accounting and auditing, they had to move around our timetable
Yes,
slots as well. That's why, according to the timetables that you have for third years,
yes,
there might be an opening around those times, but according to the timetables that we have, I
yes.
don't have an opening.
Okay, I will confirm with the timetable people. I'll ask him to just send me the updated one if there's any updates.
Okay, thank you.
All right, you're welcome. Okay, I see there's more hands up. You may put on your mic and speak. Okay. All right, guys, so let's continue. Okay, so for the first class of capital allowances before recess, we focused on section 11E and section 12C. So remember those two sections that had to do with movable assets. Okay, so please make sure you understand those sections pretty well because we are moving on. So today we are looking at section 12E now. Now, section 12E is basically including both section 11E assets as well as section 12C asset. But what we call it now, we're not calling it no more section 11E and 12C, we call it section 12E. Why? Because all our movable assets within our company are going to be taxed according to section 12E. Okay, so what is section 12E and what does it mean? It's basically small business corporation section. Now, the reason SARS brought this into play into South Africa is to, number one, to stimulate our economy. Okay, how do they do that? By producing more small businesses. So the more businesses you have, the better the economy runs, the more money is made, etc. Okay, so in order to stimulate more businesses, SARS has put a favorable tax section in place for small businesses. Okay, so how does SARS do this? Well, through capital allowances, which we are dealing with now. So you will see that as we go through the work, section 12E has got greater capital allowances. If you have to compare it to section 11E and 12C that we did before recess, okay, so it's more favorable to the taxpayer. And also, small businesses are not taxed at 27%, but they are taxed at a sliding scale. So the more you earn, then they will tax you. All right, so there's a big advantage, and you will see now when we do questions in that. Okay, so what happens if you are classified as a small business corporation? Now, this doesn't just automatically happen when companies do their tax returns and whoever is doing their e-filing, etc. That accountant or that tax practitioner needs to notify SARS that this company is applying as a small business corporation for tax purposes. Okay, so it does not automatically apply. The tax practitioner has to elect for small businesses to actually apply. All right, so that is very important, and a lot of people are not aware of that. So they actually lose out on this advantage when it comes to business tax. Okay, so this section 12E is applicable to manufacturing and non-manufacturing assets. Now here we're specifically speaking about movable assets. So basically what you can tell me is, okay, so it applies to all Section 11E assets and it applies to all Section 12C assets, basically. Okay, it has to be owned or acquired by the taxpayer. Okay, and it also, if you have purchased it under credit agreement or if you have purchased it cash, it does not matter as long as the owner owns the actual assets. Okay, it has to be brought into use. Okay, exactly like the other sections. In order to claim it, we have to bring it into use, but it has to be used for the first time by that taxpayer. So this one is an interesting one, right? Because that word first time means you could not have used it previously. So a good example of that would be, let's say 4 years ago, I had an asset, a machine that I was using in my business. And now I take that machine and I sell it to another company. And maybe 2 years later, I buy that machine back from them. That means that machine, I'm not allowed to claim any allowances under Section 12E. Why? Because it's not the first time I'm using that. Okay, so it has to be for the first time you're using that. Now, those transactions seldom actually really happen, but it's just nice to be aware of it. If a transaction does happen, what do you do with it then? Okay, the assets obviously have to be used for trade purposes, not for personal purposes. And in order to qualify for Section 12E, the gross income must not exceed 20 million for the year. So they've really limited this actually. It's specifically for small businesses. So if you want to say, well, how do we know what is a small business? Well, we look at their gross income. If the gross income is less than 20 million Rand, they can qualify as a small business corporation. Okay, this is applied to CCs as well as private companies only. Okay. Okay, so let's look at the cost of assets here. So what happens if there's a market and a cost price? Well, the rule says we will always use the lesser if it's cost or market value. Okay, if I just give you the cost, you're only going to use the cost. If I give you the market and the cost, you will use the lesser of the two. And if I only give you a market, you will only use the market value here. All right. Then we have to add, remember we capitalize costs, so the same principles as what we learned the week before recess, Section 11E and Section 12C. Remember the cost. What is capitalized to the cost price of an asset? Okay, installation costs, erection costs, moving costs, any cost associated with that asset will be capitalized. Okay, then the most important here, allowances. So how do we work out the capital allowance on a Section 12E asset? Okay, so it's pretty easy. 100% will be written off for all new or used, which is second-hand manufacturing machinery and plants when brought into use. Okay, so this one is a bit different from Section 12C. Okay, Section 12C had the two write-off periods, depending on whether it's new or second-hand. Whereas here, when we're in Section 12E, whether it is new or second-hand, it is irrelevant, okay? As long as that asset is used in the process of manufacturing, you will get 100% allowance the year that you bring it into use. Now, can you see already this here is a big gain for any small business? I mean, if you take a small business, a manufacturing business, for example, your startup costs for a manufacturing business are very high. Why? Because you need to purchase machinery. Okay, now you're starting off this business and now your machinery are quite expensive, 50,000, 100,000 a machine. What is nice about this section is that you are allowed to deduct the cost price immediately, 100% when you bring it into use. So there's a big advantage here when we're starting off a small business as well. Okay, then it goes on and it says 50, 30, and 20% for other type of assets which would have qualified for Section 11E. So we're speaking about non-manufacturing assets now. Okay, so if I'm in Section 12E, what happens with all my other assets? my non-manufacturing assets, so all my other movable assets. And we say qualifying under Section 11E because by now you should all know what is a Section 11E asset, right? So examples of those will be your desks, your laptops, your chairs, the canteen microwave, cell phones used within the company. So all your movable assets, those are going to be written off at 50, 30, and 20%. No apportionment. So the first year you bring it into use, you will write off 50%. The second year, 30, and the third year, 20. Same principle. Can you see that if I have to compare 11E now to this section, there's a better benefit here. The first time I bring it into use, I already get 50% of my cost price written off. Okay, whereas with 11E, it wasn't like that. If you took note, when we did 11E, it was basically like 4-year write-off period or a 5-year write-off period. So the percentage was much lower, but over the period. Okay. Then there's another special provision within here, within this section. So it says, a taxpayer may choose to apply either Section 12E or Section 11E, allowance for assets other than new and unused manufacturing plants. So what are we saying? We're saying, number one, any other asset within the company that is written, that would have been written off under 11E, okay? So now it's written off at 50, 30, and 20%. The taxpayer, as a taxpayer, you have an option to either choose 50, 30, 20, so either choose Section 12E, or you may elect Section 11E. Okay, but it's only for this section here that you may choose. Now, when you sit and you think, okay, so what is the point of allowances and deductions, right? The higher my deduction, the higher my allowance, the less my gross income. Okay, the less my taxable income.
Chomi.
Hello?
Hi, Chomi.
Sorry, is there a hand raised? Would you like to ask a question? Yeah. Right. So let me give you an example. So remember, as a taxpayer, you're always looking for the greatest allowance or deduction immediately. Okay. So let's say I tell you that you bought an office chair, and that office chair cost you 3,000 Rand. And I tell you that your business is a small business corporation. So now you know that Section 12E is going to be applicable. Okay. But because this is an office chair, it basically falls under the second criteria where it's going to be written off over 3 years, 50, 30, 20. But now you've got an option here. You can either choose 12E or you can choose Section 11E. So the chair costs 3,000 Rand. Which option would you rather write off that asset under Section 12E or Section 11E? You can type it out in the chat or you can raise your hand and ask a question. Okay, so I've got a student who says 12E. Anyone say 11E? Okay, so remember I said you're always looking for the greatest allowance, right? What was who can remember the special rule in Section 11E? So I called that the golden rule. What was the golden rule under Section 11E? Anyone remember that? Hey, you're welcome to type it in or put up your hand and use the mic. Okay, so what was the special rule in Section 11E? Remember we spoke about the 7,000 rule. If we purchase an asset, movable asset that qualifies for Section 11E, anything that is 7,000 and below can be written off 100%. So in the question I just asked you now, I've got an option. If I choose to write that asset off under section 12E, I'm only going to get 50% in the first year. So the first year I'll only get 1,500 allowance. But if I choose to elect section 11E, because it's a small item, I can deduct the full amount, the 3,000. So as a taxpayer, you're always looking for the greater amounts, okay? So in this case here, you would rather elect section 11E to apply. That's what we would do. Okay, everyone happy with that? Yes. All right. Very important, there's no apportionment for the year. So when we are writing off assets under section 12E, whether it's 100% or the 50, 30, 20, we never ever apportion for the year. Okay. Now this is the tax table that you will use in order to calculate the tax liability of a small business corporation. So if we look at this table, can you see there's such a great benefit here? I mean, the first 95,000 is tax-free. Then you only start paying 7% of anything above 95,000 up to 365,000. So it's really small tax that. If you earn, what's it, 365,000 and you multiply that by 7%, how much tax is that? Let's just work it out quickly. 365,001 multiplied by 7%, it's 25,000 for the year. Compare that to now 27%. If you did not qualify as a small business corporation, or maybe you did not elect it because you're not aware of it, okay, what would you have paid then if we had to work out 27% on that? 27%, that's 98,000 Rand. So would you rather pay 98,000 Rand or rather pay the 25,000 Rand? Okay, so there's a great benefit in small business corporation. Okay, please note you don't have to study this table off by heart. This table will be given in all tests and exams and that. You just need to know how to calculate this table. So I think what we will do now is we'll just do a quick calculation. So I just want to make sure everyone knows how to actually work around this table. Okay, so maybe on the side on a piece of paper, just write it down. If I tell you to work out tax, let's say the taxable income was 400,000, what will your calculation be? So I'm going to give you about a minute to work it out. But how you will read it, you'd ask yourself, where would 400 fall under which category? So everyone happy, 400 would fall under the third category. Okay, now you need to read the rule. So what does the rule say? The rule says that you are going to pay tax of 18,848. That's a given. That must be included in your calculation. Then you will pay an additional tax of anything above 365. So what you'll do is you'll take your 400 minus 365 because you want to work out what is the difference. And that difference, you're going to pay tax 21% tax on the difference. Okay. So let's quickly just do that. I'll give you a minute to work it out. If your taxable income is 400,000, what will the tax payable be to SARS? Okay, once you have your answer, you may put it in the chat. Let's see who got the answer correct, yeah. Okay, anyone else want to put an answer down? Okay, so for the students who put your answer down, the correct answer is majority of you got it, 26,198. Okay, so it's important you understand how to use that table, but if you got this right, you can do any of the categories. All right, so well done. Now, just imagine if this was a normal company. So we did not elect for small business. What would your tax be if we did not elect small business? So you would say 400 multiplied by 27%. You would pay 108,000 Rand tax for the year. So can you see the big advantage? I mean, I'd rather pay 26,000 than 108,000. Okay. Okay, then there's a question. Are we always supposed to round off the values? Yes, you can always round off values, but always round off your final value. So don't round off values within the calculation, only your final answer. Okay. Okay, so I think everyone's comfortable with the table. All right. So let's do a question to see how do we apply the section? How do you know when to apply the section as well? Okay, so the required says calculate the tax liability of X Limited for the year of assessment ending 28 Feb 2025. So remember I told you guys in class, right? As soon as you see the year end, what must you do? Write down your timeline. So what will be my first day of my year of assessment? The first day will be 1 March 2024 and my year end will be 28 Feb 2025. It's important to write those timelines. Why? Because it helps us when we're calculating allowances to see when did we purchase the asset? Was it 2 years ago? How many months did we use it this year of assessment, etc. Okay. Then it says X Limited is a small business corporation. So what does that mean? As soon as you see small business corporation, you're going to write down, right, all my movable assets will be written off under section 12E. So we're going to ignore section 12C. We're not interested in section 12C. We're only interested in section 12E. But we're also going to ignore 11E, but we might still use it. It depends. Okay, so that is how you need to think of it. Okay, so they want us to work out tax liability. What does that mean? You need to calculate the tax according to that table that we just worked through. Okay, so it says X Limited acquired a new machine for 100,000 Rand on 1 October 2024 and brought it into use for the first time on 1 December 2024. The machine was used in the process of manufacturing. So please tell me for this new machine, how much are we going to write off during this year of assessment? So the first thing you need to ask yourself is, when did we bring the asset into use? So we brought it into use on 1 December 2024. So please tell me, did we bring it into use during this year of assessment, the year that we're currently working in? Yes or no? Did we bring the asset into use during this year of assessment? Yes, we did. Okay, well done. Yes, we did. So now that we brought it into use during this year of assessment, how much are you going to write off? Now that you know we're in section 12E, why? Because it states here is a small business corporation. So how much are you going to write off? What percentage? Give me the percentage you'll write off. So remember, I've got 100, I've got a 50. Okay, so let's go back up to the main principles of section 12E. What did section 12E say? For all manufacturing movable assets, whether it is new or second-hand, we will write it off at 100%. For all other movable assets, so any other movable assets other than manufacturing assets, that will be written off under 50, 30, and 20. Okay, so because this is it's a machine used in the process of manufacturing, we are going to write it off at 100%. So we'll get the 100% write-off period. All right. Next one says X Limited acquired a vehicle for 100,000 Rand on 1 March 2024 and brought it into use on the same day. So everyone happy? A vehicle is a Section 11E asset, right? But because we're under Section 12E, we need to look at the 12E rules. So remember, the vehicle will fall into the second category. Okay, it's a non-manufacturing asset. Therefore, we're going to write it off over 3 years, 50, 30, and 20. But also remember, for these type of assets, I've got an option. I can either write it off under Section 12E, 50, 30, 20, or I can select Section 11E. Now remember, if I select Section 11E, I have to give you the write-off period, and I give it to you at the bottom. I said SARS allows a wear and tear allowance of 20%. So now you need to ask yourself, okay, if I go Section 11E, I'm only going to get 20% for the next 5 years. But if I go Section 12E, I'm going to get write it off faster, and I'm going to get 50% now in the first year. So which option would you go for? Now, whenever you want to make that decision, remember, as a taxpayer, the more deduction you can get, the more allowances you can get, the better for you. So which option would you opt for vehicles? Would you opt 12E or rather write it off under Section 11E? Okay, so you all, okay, I've only got 12E, 12E, 12E. I've got one Section 11E. Okay, so the answer for that one is definitely Section 12E. Why is it Section 12E? The vehicle cost, what was it again? 100,000. So if I choose Section 12E, for this year of assessment, I'm going to get a deduction of 50,000 Rand. If I choose Section 11E, I'm only going to get 20% this year, which is 20,000. So as a taxpayer, you're looking for the greater deduction you can get immediately. So the answer would be Section 12E. Okay. Then I've got another question here. Why are we deducting the full 100% on the machine if it was brought into use for the first time last year? Okay, so let's go back to that question. Machine, when did we bring it into use? 1 December 2024. Please tell me, when does the year we're currently working in is 28 Feb 2025. So that's why I said at the beginning of this question, it is important for you to write the year we're working in. The first day of the year of assessment will be 1 March 2024. The last day is 28 Feb 2025. So 1 December 2024 falls within my year of assessment. Happy with that for the student that asked the question? Okay, you're welcome. Right. So the next one says X Limited acquired a laptop for 5,500 on 1 January 2025. Okay. So again, a laptop is a Section 11E asset. So we know under Section 12E, we're going to have to choose the second option, which is 50, 30, 20. Okay, a laptop is a movable asset and it's not used in the process of manufacturing. So now that we know that we're in the second option, you need to ask yourself, are you going to stick to Section 12E or are you rather going to select 11E? What would you do? You can put it out in the comments. So the value was 5,500. And also, I'll just add there, it was acquired and brought into use and brought into use on the same day. Okay. So which section would you prefer to write this off? 12E or Section 11E? Okay, correct. Section 11E. Why? Because if I choose Section 11E, I'm going to get my full 5,500 written off this year. Okay. Then it says taxable income before the following transactions were taken into account amounted to 300,000. So everyone happy? That will be my starting point of my calculation. Okay, so let's have a look at the solution. Here's my solution here. Taxable income for the year was 300. It was given. Then I've got section 12E, the new machinery. We said it's 100% written off. Then I've got the delivery vehicle. We opted rather to stay within section 12E, so we need to apply the rules for section 12E, 50%. And for the laptop, we opted for section 11E, 100%. We got the 5,500. So yeah, I've got my total deductions, total income. So my taxable income is going to be 144,500. So now if you look at the tax table that we worked on, 144,500, let's have a look at our table. 145,000. So everyone happy? It will fall into my second category here. So what does the rule say? The rule says you will pay 7% of any taxable income above 95,750. Okay, so if we look at that solution, it's going to be tax liability. We need to work out the difference between what the taxpayer actually earned, 145,500 minus the 95,750, and the balance there is 48,750 multiplied by 7%. So this company only had to pay 3,412 Rand for this year of assessment. Okay, students, any questions on section 12E that you would like to ask, or maybe clear, maybe you didn't understand one or two principles there? Okay, so what is important and how I suggest you study section 11E, section 12C, and section 12E. You study them together. So take a piece of paper and divide it into 3 columns. You're going to put there 11E, 12C, and 12E. You put the similarities next to on one line. So, for example, 11E, you can use cost or market value. If I give you both, you will always just use cost. So you need to know the rules within that section. Okay, so for example, you would say 11E, cost, market value, either one. Okay, but if I give you both, you always choose cost. If I don't give you cost, you'll choose market value. Then under section 12C, you're going to say the lesser of cost or market. Okay. If there's no cost price at all, then it's going to, remember the special rule, you're going to apply section 11. And then you're going to look at section 12C. 12C is straightforward, what we just did. So that is the best way how to study all of these 3 sections. So remember, 11E, 12C, and 12E have to do with movable acids within the company. Only movable acids. Okay. Okay, so I've got a comment here in the chat. Can you please do the 400,000? Right? So the 400,000, I can do that again. It's not a problem. Do you want me to type it out on the chat? Yes or no? I'll just type it out. Yes. Okay. So remember, the 400,000 we said falls under which category? So let's just go back to the slide. The 400,000 will fall into the 3rd category. You understand how I got that? Yes. Okay, so what does the category tell me? It tells me I'm going to pay tax of 18,848. I have to pay that tax. I don't have an option. Okay. Then it says I will also pay an additional 21%. Okay, 21% of any amount above 365,000. So how much did this taxpayer actually earn? The taxpayer earned 400,000, right? So I want to know what is the difference between 365,000 and 400. Okay, that difference is equal to, so that difference is 35,000. No, what is the difference? I think it's more. Let me just work it out here. No, it is. It's 35,000. Sorry. That difference is 35,000. You're happy with that? The 400 minus the 36. The difference is 35. So what is the rule saying? We are going to pay anything above 365, which is 35,000. We're going to pay an additional 21%. So if I have to work out the 21% on the 35,000, it works out to 7,350. Okay. So now you're going to say, right, oopsie, I pressed enter there. Anyway, the total tax then is going to equal to 18,848 plus the 7,350 to give us a final tax value of 26,198. Okay, do you understand now how we got to the tax amount? Okay, you're welcome. Okay. Any other questions on section 12E?
Ma'am, I have a question. For the first
Yes.
transaction, right, that you used for the 100%, I get the fact that you said it's on the 1st of December 2024,
Yes.
meaning that it's within our financial period, right? So
Yes.
I'm struggling to link that into why we regard it as secondhand. Can you please help me with that?
Second hand. Let's read. I think it was new. Where's the question? So it said the company acquired a new machine. So for this question, it was a new machine. Even if I said it was a second-hand machine, for section 12E, it's irrelevant whether it is a new or second-hand machine. As long as the machine is used in the process of manufacturing, it will be written off 100% the year it is brought into use.
Oh, okay. Thank you, ma'am. I understand.
Okay, you're welcome. Okay, any other question on 12E? Okay, guys, so this is like it's such important information. It's like I spoke to you in class before recess, and I said whether you take tax into a career or whether you take tax as a personal thing. So if you just take it in your own life and one day you open your small businesses, you're able to do your own taxes. Why? Because of the knowledge you learned. A lot of tax practitioners out there are not even aware of Section 12E. Why? Because they don't familiarize themselves with the act or they don't update themselves. They just stick to the old rule. So it's important that you understand these rules. A lot of students after these classes, they go and they give their family advice. And why don't you do this? Tell the bookkeeper to look at this section, and they save their families a lot of money. Okay, so yes, it's very interesting even for your personal life. Okay. Now, the next section we're going to move to is what happens if we got immovable assets. So how do you write off your property, your land, things that are immovable? Okay. Capital allowance, building allowances. All right, so a building allowance, we look at different types of building allowances. So the first one we're going to look at is buildings that are used in the process of manufacturing. Okay. Now, there's quite a bit of information here, but you need to just separate the information. Okay. So what happens if we have a manufacturing building? Number one, we can only apply a building allowance if the taxpayer has to own the building. Okay, they have to be the owners. What happens if the building is leased? Who is allowed to claim the allowance on the building? Only the leaseor. Why? Because the leaseor is the owner. So the leasee is not allowed to claim allowances on the building. Okay, and another thing, it must be wholly or mainly used in the manufacturing process. So what does mainly mean? Mainly means more than 50% of the building is used in the manufacturing process. Then it is classified for tax purposes as a manufacturing building. Okay. So it's very easy requirements. I think it's, it's exactly the same as the other assets. Taxpayers have to own the asset. It has to be used by the taxpayer. The only difference with this, it has to be used in the manufacturing process. Non-qualifying assets, very, very important. There's no tax allowance on land. You will never ever write off land for tax purposes, okay? So in a test or the exam, if we tell you you purchased land and then you started building a manufacturing building on it, please remember always to address land. Okay, you will put there land is zero allowance. Why? You must remember, always tell me, why are you saying there's no allowance? Because according to the Tax Act, there's no allowance on land. Okay, always give a reason. And that is an easy mark, so don't ever forget land. Okay, then it says improvements to subsidiary buildings, buildings not used in the process of manufacturing. So here we only focus on buildings used in the process of manufacturing. Okay. Now we're going to look at two types of buildings. Manufacturing buildings that we actually build, that we erect. Then you get manufacturing buildings that we purchase. Right, the ones that we purchase, it's very easy. We'll get to that one at the end of this section. So let's have a look at what happens if we build a manufacturing building. How does it work? Okay. Number one, there's specific allowances for specific periods. I'm going to show you that table now. The asset must be brought into use or used during the year. Okay, we all know that for tax purposes, any asset must be brought into use. So that's a general rule. We do not apportion for the year. Okay, just like Section 12E and Section 12C, we don't apportion. If we only use that asset for one day of the year, we get the full allowance. We never apportion. Okay. Interesting, it needs to have a cost price. Who can tell me which section did you also see this requirement? It needs to have a cost price. Can anyone tell me? Which section does that also apply to? Okay, we did it before recess. Section 12C, thank you very much. That's correct. Okay, Section 12C, well done. Okay, so again, it needs to have a cost price. Very important, highlighted in red. Cost does not include clearing and leveling the site in preparation for construction, excavations, and external paving and fences. So I can give you a whole list of costs involved in building this building, okay? And let's say I give you any of these costs. These costs are not allowed to be included in the cost price of the building. So what do? You will list them and you'll say zero. Why? Not allowed. Okay, not allowed according to the Tax Act. These are specifically excluded from the cost price of a building. All right, so please remember these specific ones. Okay, this also applies to research and development buildings. So basically, the same rules that apply to manufacturing buildings also apply to research buildings. Okay, I will not test you on research buildings. I will test you on manufacturing buildings. But going forward, if you do take tax to another year, or you do the advance or the degree, you will do research buildings as well. Okay, now the table we are looking for is this table. Now, when it comes to manufacturing buildings that are erected by a taxpayer, we need to determine what allowance we are going to use. And how do we determine and where do we get that allowance? The allowance you use will always be, you'll always have to look for the date that you started constructing the building. The date that you start constructing the building, you go and have a look on this list to say, okay, I started constructing the building, let's say, I don't know, July 1999. Okay, so I go to this table and I say, right, July 1999 falls on the second last one, July. So this is on or after 1 July 1996 to 30 September 1999. So the allowance there is 10%. Now, what are we determining? The only thing we're determining here is the percentage I'm going to use. That's the only thing I'm determining. When do I start calculating the allowance? Only when I bring the building into use. So even if I only bring that building into use 5 years down, or maybe a year later, only then do I start using the 10% rule. Okay. Now, for your purposes, you only need to know the last two. It's either 10% or 5%. All right. So that is important. So I'm going to say it again. How do I know what to use, what percentage? You always look for the date that you started constructing the building. You'll come to this list and you'll say, right, which date does it fall under? If it's anything after 1 October 1999, you will use 5%. When do you start calculating it? Only when you bring it into use. Simple as that. Okay. So let's do an example. Company A is a bicycle manufacturer with a February year end. It starts building a factory in which to house its production process on 1 January 1999. The building costs 2.5 million. It brings the building into use on 1 January 2000. It commences renovations to add another floor to the factory in 2015 and brings this new floor into use on 1 October 2015. The cost of the renovations amounted to 900,000. So when it comes to building, there's always a lot of information, okay? And the calculation is generally small. But the reason for the information is because we need to decide, when did we start building it? They need to give us dates. We need to determine what is the percentage and when it is brought into use. So how do we start with this question? Number one, it says it started building a factory. So that means we need to look at the rules that go with the erection of a company, the building of a factory. Okay. So what does the rule say? The rule says, number one, how do you determine what percentage you're going to use? So we need to ask ourselves, when did we start with building this? We started 1 January 1999. So let's go up to our table. Where does 1 January 1999 fall on, students? Everyone happy? The second last one, it falls here. So what percentage am I going to use? I'm going to use 10%. Now that I know the percentage, I need to ask myself, when did we bring the asset into use? The building was brought into use on 1 January 2020. Okay, so what does that mean? I'm going to start writing off this building in basically the February 2000, or not 2020, 2000 year of assessment. That is when I will start writing off the building. So we're going to say 2.5 million multiply by 5%, and we start writing it off from 2000. Okay, so there it is, the annual allowance, starting tax year, end of February. Why end of Feb 2000? Because we only started using it 1 January. We started using it 1 Jan 2000, which falls into the 2000 year of assessment. Okay. Now it goes on, and now they tell you after 5 years, in 2015, they bring this new floor into use. The cost of this renovation amounted to 900. So at this point in time, we're not going to ask ourselves, what is the remaining lifetime of this building, like we did with movable assets? You're not going to ask yourself. We deal with it separately. So the floor, the new building floor, will be seen as a separate asset, okay, when we calculate allowances. Okay, but one day if you ever do sell the building, you're obviously going to add the total of the expenditure to get your total costing. But for tax purposes, we keep it separate because we're going to calculate the allowance separately. Okay, so for the floor, when did you start renovating, start building this floor? It was in 2015, And then it says it was also brought into use on 1 October 2015. So now we go back to the list. We say, right, October 2015 will fall under which category? Everyone happy? Definitely the last category. It was after 1999, and we're going to use 5%. Now we know what percentage we are going to use. When do I start calculating the percentage? The year I bring it into use. So 1 October 2015 will fall into the February 2016 year of assessment, right? We start from 1 March 2015 up until February 2016. So then we're going to say 900 multiplied by 5% to give us 80,000 Rand. Okay, any questions when it comes to manufacturing buildings? So what are the main principles of manufacturing buildings that we are going to construct? Number one, you always have to check, is it a manufacturing building? Number two, if we're constructing, you always have to check, when did I start constructing? Why do I want to know when? Because that is going to determine what percentage I use, 10% or 5%. Okay? And number three, the next question you need to ask yourself is, when do you bring it into use? When do we start calculating the allowance? Okay, very important, we never apportion. So we never multiply by number of months and that. It's very straightforward. Okay. Any questions on this manufacturing building? Yes, I think you're all a bit fine with that. So let's continue with the next one. What happens if we don't construct a building, but we purchase a building? Okay, that is much easier. So it's simple. Even though there's some rules to it, but you will get the rules. It's not difficult, okay? So what happens if we buy a second-hand building? We purchase it. When are we allowed to claim the allowance? Number one, only where the previous owner was entitled to the allowance and the previous owner used, okay, well, the current owner and the previous owner used in the process of manufacturing. So what are we saying here? We are saying only if the previous owner was entitled to the building allowance. So if the previous owner was entitled to it, okay, that means the previous owner did use it in the process of manufacturing. That's the reason they could claim it. So that one is ticked off. But now, if you're purchasing it, you must also use it in the process of manufacturing. Well, we all know that, right? That's a general rule. If you're going to claim an allowance on a manufacturing building, it has to be used in manufacturing. So that one is pretty simple. If you buy a second-hand building, you need to ask yourself, did the previous owner who I'm buying it from, did they use it in the process of manufacturing? If your answer is yes, and you are also using it in the process of manufacturing, you are allowed to claim the allowance. Okay. What happens if the previous owner did not use it in the process of manufacturing? So that means they did not claim a building allowance. That means you are also not allowed to claim it, even though you are going to be using it in the process of manufacturing. So for used buildings, you always have to look at, what did the previous owner do with this factory? Okay. Now, yes, I'm sure there are, and I know there are other sections where you are allowed then to claim it, but we do not cover that in this course, okay? So we just focus on these sections. Okay, so what you need to know for now is, if the previous owner was not allowed to claim the allowance, and even though you use it in the process of manufacturing, you are also not allowed to claim it. Okay, so used buildings where the previous owner was not entitled to claim the allowance and used by the taxpayer in the process of manufacturing, you are not allowed to claim the allowance. No allowance. Okay, what happens with new buildings? Well, new buildings is the most easiest. As long as you, the taxpayer, are using it in the process of manufacturing, you are allowed to claim the allowance. Okay, now what allowance are we allowed to use? That is a very important one. Okay, if I purchased a second-hand buildings, I can only use the allowance that the previous owner used. If I buy new buildings, I can only use 5%. So what is important about used buildings? I need to give you that information. I need to tell you the previous owner maybe purchased the building and use it in the process of manufacturing on whatever date. So now you know if we purchase, it's automatically 5%, okay? But what happens if I tell you the previous owner constructed the manufacturing building and they constructed it, I don't know, 1 July, what can I use? 1 July, let's go check our tables here quick. Let's use something different. Let's say 1 July 1999, okay? And I tell you that he was allowed to claim it and he used it in the process of manufacturing, blah, blah, blah. So I give you all the information of that person. Now, why am I giving you that information? I'm giving that information so you are able, number one, to identify what allowance the previous owner used, because now you can also use the same allowance. And number two, was the previous owner allowed to claim it? So if I told you the previous owner constructed it on 1 July 1999, what percentage was the previous owner allowed to use, guys? Everyone happy? The previous owner was allowed to use 10%, right? Okay. Now the previous owner also used it in the process of manufacturing. Now I'm buying it from them. So what happens? I'm allowed to claim the allowance. So whatever amount I purchase it from, let's say I buy it for, I don't know, 500,000, I can write off 10% per year. How did I get the 10%? From the previous owner. Okay, so that is how, it doesn't get more difficult than that. That is how you need to think about it. All right. And then for any new buildings, that is very simple. It will always be 25%, not 25, sorry, 5%. So anything purchased on or after 1 April 2000 will always be 5%. And with us, when we test, we always test more than 2000. So before 2000 is really irrelevant. It will really not have any effect on any tax calculation because we sit in the 2025 year of assessment. Okay, so we'll always test it after 2000 for new buildings. Okay, any questions on buildings? Manufacturing buildings specifically. Okay, so I think I will just do a quick recap. Okay, so when you deal with manufacturing buildings, what do you need to ask yourself? Number one, did we construct it or did we purchase it? Okay, if it was constructed by you, the taxpayer, okay, what do you need to do then? You need to ask yourself, when did construction start, to determine what the percentage you use. When do you start calculating that percentage? Only when you bring the manufacturing building into use. Okay. Then the next one is purchase. What happens if we purchase a building? Okay. If I purchase the building secondhand, I need to determine if the previous owner, number one, was allowed to claim the allowance. And then I need to determine what amount, what percentage of the allowance were they able to claim. So that will come all in the information. Let's say the previous owner was not allowed to claim anything. You as a taxpayer can also not claim anything. But if the previous owner was allowed, you are also allowed as long as you also use it in the process of manufacturing. Okay. If you buy a new manufacturing building, it's simple. You'll always write it off over 5%. Okay, 5% is what? 20 years, basically. Okay, and that is like manufacturing buildings in a nutshell. So always know the two types, if I'm constructing and if I'm purchasing, and learn the rules for each one. Right. The next building we look at is commercial buildings. So basically, it's all other businesses, all other business buildings other than manufacturing buildings, right? Commercial means business. Okay. So this one is very simple and easy. It actually came into the Act in 2007. So it's not, I mean, it is kind of old, but not extremely old. Tax has been here for years and years. So it is kind of a new section, we could say. Very important, you need to know the rules of this section. Okay, so it has to be new and unused. So in order to claim an allowance on a commercial building, has to be new and unused. If it's secondhand, you're not allowed to claim it. Okay, not allowed to claim it under this section. There might be another section, but we do not cover other sections in this course. Okay, so we're only looking at this section. It has to be purchased or erected, so it can be you can construct the commercial building or you can buy it by the taxpayer on or after 1 April 2007. What happens if it was before this date? No allowance. The building is wholly or mainly used for the taxpayer, for tax purposes. So it has to be used for business, basically. And it has to be used during the year to claim it for the purposes of producing income in the course of the taxpayer. So if I had to sum up these rules, it's simple. Has to be new and unused. So that means no second-hand buildings allowed to be written off under this section. Number two, it's only applicable to buildings after April 2007, and the building has to be used in the taxpayer's business. All right. Section 13, the allowance will always be 5% and we do not apportion. So let's have a look at a question. It says, Company C owned the following assets during the 2025 year of assessment. Company C acquired an office block for 400,000 on 1 January 2024. Factory C used in the process of manufacturing was acquired on 1 January 2024 for 450, and Company C acquired land for 250,000. Required, calculate the capital allowances to be claimed by Company C for its year of assessment ending 21 March 2025. Okay, so what is important here is, number one, what year of assessment are we working in? So please give me the first day of my year of assessment. You can type it out in the chat. What is my first day of my year of assessment? Anyone want to give me the answer? So I said my year ends 31 March 2025. So what is my first day of my year of assessment for this tax period? So remember, it's a 12-month period. So what would my first day be? It will be April 2024. Okay, so basically my year of assessment here will be 1 April 2024 to 31 March 2025. Everyone happy? Okay, that is the period I'm working in. So now we are dealing with buildings. So now you need to determine, am I dealing with a manufacturing building or am I dealing with a commercial building? Okay, now that you know the rules, you need to apply it. So number one, an office block. Can you please tell me what is an office block? Will it fall under manufacturing or commercial? Office block, is it manufacturing or commercial? Commercial, happy. So now that you've identified that it's commercial, you need to apply the rules of commercial. So what is the rules? Number one, it says it had to be new. Okay, so this one doesn't say it acquired an office block, so you can assume that it is new. Okay, you can assume it. If I don't say new or secondhand, you assume that it's new. That is the one thing. Number two, it had to be acquired after 2007, which it definitely was. It's 2024 already. Okay, and it has to have a cost. Well, we've got the cost. Okay, and it will have a cost. It's new, so the 400,000. How much are you going to write off for commercial buildings? Anyone remember? What is the percentage for commercial buildings? We just did it now. The last building, what is the percentage? 5%. Yes. Okay, well done. 5%. So we'll say 400,000 times 5%. Are we going to apportion, guys? Does it matter that we only used it for what? January, 3 months. It does not matter, right? Because for buildings, there's no apportionment for buildings at all. Okay, the next one was factory C is used in the process of manufacturing. It was acquired on 1 January 2024. Okay. Please note that they were all brought into use, so acquired and brought into use on 1 January 2024 for 450. So now you need to ask yourself, okay, I'm dealing with a building. Is this building manufacturing or non-manufacturing? Well, they say it's in manufacturing. Now that we know we're dealing with manufacturing, you need to ask yourself, did you construct it or did you buy it, acquire it? So in this question, we acquired it. So now you need to think of, okay, what happens if I acquire a manufacturing building? I need to ask myself, was it secondhand or new? So again, it does not say anything about secondhand, so we assume that it is new. So happy it's a new building, 450. What is the percentage? Anyone remember? If I acquire a new manufacturing building, the percentage will be not difficult, guys. 5%, same as admin
5%.
buildings. Yes, correct. Thank you for that. 5%. Okay, then the company C acquired land for 250. Is there any allowance written on land? Yes or no? Land. Any allowance? No, right? Special provision, no land. If you just see land in your test, make sure you write land, 0, no allowance, not allowed. Okay, so let's have a look at the solution. We've got office buildings, 400 times 5%. That's my allowance. Factory C, the cost is 450 multiplied by 5%. Land, no allowance, 0. Total allowances to be claimed is 42,500. Okay, so that what we just did now is non-movable assets, buildings. So we only deal with manufacturing buildings and commercial buildings. Those are the only two buildings we deal with. All right. So the next section is recoupment, but I think I'm going to keep this for our face-to-face class because you really need to understand the concept of recoupment here. And I think you've just learned about section 12E, so the information is still there. So I prefer rather to do that then because I know a lot of students by this time are already tired. Okay, so we will continue recoupments in the face-to-face class this week. So please make sure that you attend. It's very important. It will be tested in next week's test. Okay, recoupments will definitely be there. So please make sure you attend. It's not a difficult concept. Once you understand the concept, you can basically do any question when it comes to recoupments. Okay, so I just want to recap on what we have done before recess up until now. Okay, and please, if you did not attend class before recess, please make sure you go back and listen to the recording and you go through your slides. Because when we start with recoupments this week, you need to know the rules of capital allowances. You need to know your different assets. Otherwise, you're just going to get confused. Recoupment is a building block on top of capital assets. Okay, so a big calculation from the time you start calculating your allowance up until a recoupment can go up to 15 marks. That's just one calculation. So the work that I have taught you. So please make sure that you understand section 11E, understand section 12E, understand section 12C. Those are all for movable assets, and then the assets that we did, buildings, manufacturing buildings and your commercial buildings. Please make sure you go through your slides before you come to class. So when we start off with recoupment, you're able to understand. Okay. When can you collect test one? Test one can be collected tomorrow. There was an announcement that has been sent. I think it's from 10:30 or 10 o'clock to 1 o'clock. Okay, you can collect it upstairs by the boardroom window. You will be able to collect it tomorrow. Okay. So please, students, please remember as well that from next week, remember it's test week for the next, I think, 2 or 3 weeks. It's test week. Please go and check. Tomorrow, the test breakdown will be put up on Moodle as well. There'll be an announcement with the test breakdown, so you know exactly what is coming out there as well. All right. And then also remember the practical classes for this week. It's basically the tutors are just going to go through the test with you guys, test 1, and maybe some test technique, how to answer a specific question and things like that. Please make sure that you go through your test and you understand it. It's good practice for next week's test. All right. Any questions on your side?
Sorry, ma'am, I just want to ask, when are we going to get a test 1 marks?
You can collect your scripts tomorrow, and the marks will also be released tomorrow on Mum's.
Okay,
Class will be
okay.
released, yes.
Siyabonga, mama.
Okay. Any other questions, guys? Scope for test